Imagine checking your mail and finding a 1099-C saying you owe taxes on $5,000 of debt that a credit card company canceled years ago. For most people, that is a total heart-stop moment. You're already struggling, and now the IRS wants a piece of money you never even saw in cash. It feels like a trap.
It really does feel that way, but there's actually a legitimate way out that many people completely miss. The IRS has a specific rule called the Insolvency Exception. Essentially, if you owed more than you owned at the moment the debt was forgiven, you might not owe a single penny in taxes on that amount.
Comment 1099-C if you just got a surprise form in the mail today. I want to see how many of us are dealing with this right now.
So let's talk about what this form actually is. A 1099-C is a cancellation of debt form. When a lender gives up on collecting a debt, the IRS views that forgiven amount as income. It is as if the bank handed you the cash to pay them back. This scares people because the tax bill can be thousands of dollars.
Right. And I saw a post on Reddit where someone got a form for an $8,000 debt from 10 years ago. They were panicking because they thought the debt was long gone. They were worried they'd have to choose between paying rent or paying the IRS.
Exactly, but here's the debunk. You don't always have to pay. The IRS rule found in Publication 4681 says that if you're insolvent, you can exclude that debt from your income. In plain English, being insolvent means your total liabilities, everything you owe, were greater than the fair market value of all your assets right before the debt was canceled.
So it's not about being broke today, but about what your bank account and debts look like on the exact day they wiped the debt?
Precisely. The IRS is very strict about that timing. You use a specific worksheet to list your car, your furniture, and your bank balance against things like student loans, back taxes, and credit cards. If the scale tips towards the debt side, you're in the clear.
Poll time. Is your debt from A, credit card, B, medical bill, or C, car repo? Comment your letter and I'll tell you which one is easiest to exclude.
Let's look at a real dollar example. Say you have a $10,000 credit card debt canceled. At that moment, you had $5,000 in the bank and a car worth $10,000, so your assets are $15,000. But you also had a $40,000 student loan and $5,000 in medical bills.
Okay, so total assets are $15,000, but total debts are $50,000.
Right, since your $50,000 in debt is $35,000 more than your assets, you're insolvent by $35,000. Because that insolvency amount is way higher than the $10,000 canceled debt, the entire $10,000 is tax-free. You would report this on IRS Form 982, checking box 1B.
That is a massive relief. But wait, what if I'm only insolvent by a little bit? Like, what if I only owe $1,000 more than I own?
Then you only exclude $1,000. If the canceled debt was $5,000, you'd still pay tax on the remaining $4,000. It's a dollar-for-dollar calculation. This is why you must be honest on the worksheet in Publication 4681.
Are there things that don't count? I saw someone on Reddit say they didn't include their clothes or furniture in their assets.
That's a common mistake. You have to include everything you own, even the stuff in your house. The IRS considers the fair market value, which is basically what you could sell it for at a garage sale, not what you paid for it. Also, you cannot claim this just because you feel poor now. It has to be based on the date on the 1099-C.
So step 1 is to find that 1099-C and look at the date. Step 2 is to find Publication 4681 and fill out the insolvency worksheet for that specific date. And step 3 is to file Form 982 with your tax return.
Exactly. If you get stuck, you can actually call the IRS resource line or look up the instructions for Form 982 directly on their website.
Did you know if you owe $1 more than you own, you might pay $0 in tax? Tell me below if your debts are bigger than your bank account.
Just remember, I'm an educator, not your CPA or tax advisor. This is general information based on IRS publications, not personalized advice. Tax situations vary. Always consult a qualified tax professional about your specific circumstances before making decisions.